Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, March 30th, 2016. In this video, I wanted to take a look at the markets, and do the usual. We'll move through, I'll lightly touch on the longer-term trend, bigger picture, and then zoom down to the charts where we're at now, because we're still at that critical technical juncture. I know it seems like the market's done nothing but rocketed up, but we're really not up that much more than where we were. It seems like a lifetime since I've done the last video, but the last market overview video was done on March 21st. So that's only been 9 days, just over a week. And on that note, just to digress for 1 second, I just wanted to apologize for my lack of presence in the trading room, a relatively lack. I've been in there, as well as my lighter than usual market commentary and trade ideas, both new trade ideas and updates. Now, the function of the new trade ideas is more so I'm just not seeing a lot out there offering a good risk reward, and that's one thing you'll notice. Follow the official trade ideas on the site, and if there aren't a lot, it's just because I'm not seeing any of some very attractive risk reward setups and or the overall market, and that's a function of really my overall view. And there are times where you'll see trade ideas pumping out 3, 4 a day sometimes, and for days on end. And that's just not the case right now. So personally, I'm keeping it light. Nothing has changed since that last video. In that last video, if you check it out, March 21st, I mentioned that, at the point that I was, I had some short positions. I wasn't fully short, and I had room to add, but I would not add and haven't to any of those broad index shorts until or unless prices moved down below where they were 9 days ago. In other words, I was only going to add to those positions on strength, which in reverse, if you're short, that's weakness in the market. So the market's climbed higher, and that's one thing I can tell you in trading. I have no problem scaling in if that was a predefined plan. So I was going to scale in from point A to point B on a position. However, I strongly advise against averaging down. Most experienced traders won't average down on a losing position solely for the sake of lowering their cost basis. As I mentioned, as we get closer to these levels that I'm going to get into here in a minute on the shorter term charts, if we go much higher, the bearish case quickly diminishes. However, it is not eliminated yet, and I'll make my case for it here. I just want you to know, I really put a lot into this analysis. This isn't confirmation bias. This isn't me trying to reinforce a case that I've made for the last few weeks. It's just how I see the charts now. And again, they could change here within the next few days, few weeks, if we continue to push much higher from where we're at. But these are the same levels I've talked on for weeks, if not months now. All right, so let's dive into the trends. This is the Wilshire 5000. I often refer to this as the single most representative index for the stock market. The Dow is garbage. The Dow is 30 stocks. That is not representative of the economy, mere 30 stocks. The S&P 500 is much better, does probably right behind the Wilshire, but the S&P 500 is only mega cap, large cap stocks, the 500 largest stocks out there. So you don't have your small caps, mid caps, and a lot of other things out there. So the Wilshire is really a good look at the overall health of the stock market. And as I've gone over before, these are long-term, intermediate-term trends. Down in the bottom, I have a daily short-term trend with three different trend indicators on that short-term time frame, intermediate-term time frame. I'm using on this chart one, and a couple over here on the. It goes without saying, it doesn't take a rocket scientist or a whole screen full of chart indicators to tell you the short term and even the intermediate term trend is bullish. That's pretty clear. The black dotted lines here are the price. So we've been going up for weeks, so it goes without saying, again, the short term trend is bullish, so I won't spend any time on that. But what we will look at real quick, we'll touch on, is the intermediate term trend and the longer term trend. And that is what's formulating my overall bias right now. Still looking, for more downside in the coming months from this point. This is the Wilshire 5000, and this is the 43-17 EMA. The 43 and 17 EMA pair has done a great job. I've discussed this in the past, and I've shown this only goes back about 6 years, but I've shown this with 20-year chart history, and it's just done a phenomenal job of capturing the bulk of major trends. The major bull and bear markets or primary uptrends and downtrends. And as you can see here, the histogram just represents the differential between these two moving averages. So when you have the green above the purple or the 17 above the 43, the trend is bullish, and when it's below, it's bearish. So we're clearly in bearish territory, not even close to crossing that over yet. And again, that's the Wilshire 5000, which I put a lot of weighting into. And then real quick, we have the monthly trend, which is as far out as I go. Now this means every bar here represents 1 month of trading action, and those trends are and have been bearish since the month of we had the official month-end close in December. That's December right there. So now we're on the 4th month, and again, I've spent a lot of time in detail on these. I can just tell you nothing is 100% in trading, but these trend indicators have done, especially this one here. When you go out to the longer term, in other words, from a daily to a weekly to a monthly, you have fewer whipsaws on the longer term time frame. Yes, they get you in a little slower. They certainly get you in later and out early, get you in later and out later as well of the trends. That's why you use those shorter term trends to narrow it down. But I just wanted to confirm that overall we're still, by this metric and a lot of others I look at, in the early stages of a new primary downtrend. And if and when that changes, my analysis will change, or my outlook. And again, I take other things into account as well. Here's the S&P 500 for those of you not familiar with the Wilshire. Here's the weekly trend, as you can see, reading of negative 11.46. So meaning the differential, when you zoom in, you can see it here. The 17 is still well below that 43-week moving average, and that tells you that the trend is, at this time, still solidly bearish, the long-term trend as looked at on the weekly chart. And then just real quick, take a look at the monthly. Here's the S&P. You remember I use these two different trend indicators here. I use a 10-6 EMA pair on the monthly chart, as well as this ROC 13, sometimes an ROC 12. I've been using the 13 on more indices recently. Is it just an extra way to help scrub out those false sell signals? So you need to get red bars on both. So you can see here the ROC gave us a monthly close back in December, but the 10-6 EMA pair didn't, but it did in January, a solid close, red close, and as well in February and March. So by all accounts that I use, the long-term trend is bearish. The big holdout is, of course, the NDX. That led us up, and I've mentioned this, repeatedly in the last few videos, that is the one index that has yet to cave. But again, you take into the big picture, you look at all the global, non-U.S. markets. They've already exceeded bear market thresholds of 20%, just about all of those, I believe, the major ones. And every other U.S. index, by far, the small caps, the mid caps, the S&P 500, the Dow, you name it, they've all triggered. The NASDAQ 100, at least, has been the holdout. Now, the NASDAQ 100 is top heavy. It has the leading companies. It's not diversified because the top 10 holdings make up over half of the whole index. This is the NASDAQ composite, so this is more indicative here. You can see on the monthly, we're still on the monthly time frame, since January, and as well as in February, we had, February and March, we've both had confirmed, March, I should say March will be over today. So that's almost certainly going to close in the red and give us a second confirmation, second month that the NASDAQ is in a primary downtrend. So, all right, enough on that. That's the longer term charts. We'll take a look at the shorter term charts now, because this is, again, we're at some pretty critical technical junctures here. Okay, so enough of the trends. Now just looking at price. I'm going to go through the weekly charts on a few indexes real quick. This is the big picture here. This white trend line is what I call the primary bull market uptrend line. Comes off in most indices, the March 2009 lows. And it's very well defined, and all of those, we had a almost identical trend line in most of the previous bear markets. I've gone over that in other videos. This kicked it off. This was a breakdown. Very, very well defined, very impulsive. Again, a well-defined trend line, impulsive selling, prices broke down. There's a NASDAQ composite, still well off its highs. And again, this is my point here, is I look at the bigger picture, taking that into the shorter term analysis, and that formulates, as a trader using the charts, you look at support and resistance levels. And there are two options when a stock comes down to support. You have either an option to go long off that support level if you think that the trend will continue. If the primary trend is up, you go long, position long for a swing trade. However, if the bigger picture indicates that the trend may change or is bearish when a stock falls to support, you then want to position not to go long on support with a stop just below, but you want to get ready to short a break of that support. Likewise, flip it around. I'm making the case that the primary trend is bearish. Therefore, as stocks come back to resistance levels, yes, we've punched up through quite a few in the last few weeks, but we haven't taken out the most important levels that I've been focusing on for weeks. So again, in a bull market or a primary uptrend, or if you believe that the correction's over and the trend is up, then you do want to take breaks of resistance. In other words, the stocks come up and the markets come up to resistance levels. A break above that level is a breakout, and you can go long with a stop not far below. If you take the glass half full approach. If you take the glass half empty approach, which is a case I'm making, then you want to short resistance levels. And again, it's a little more complex than that. I already shared my personal trading strategy. I'm not at this point adding short exposure, nor have I been for the last week or two here. But this is where we're at, and I'll dig into the other charts. So this was the breakdown of the bull market uptrend line. So this began a new primary downtrend. Call it a bear market, call it a bull market, whatever you want. The trend by all those metrics I just showed you is down. We're well below that level. In fact, we have virtually no chance. I mean, we'd definitely be in a continued bull market if we go back to backtest, because it would be months before we can even backtest that trend line. So backtest is out of the question at this point of the white trend line. Now I put this orange trend line in here. I modified this slightly since the last post I put up on the composite, but I have numerous reactions. When I do a trend line, I look at the most points that touch either a body of the candlestick, that's the fat part, or a wick, that's the skinny part, shadow, tail, wick. And this trend line has numerous reactions here. I cut through that one a little bit, but they caught the bottom of this one here. You can see that that candlestick shadow, and we're back testing that from below. So that wasn't the primary uptrend line. This was the primary uptrend line, but this was from this point on, after that healthy correction we had back in 2011, that defined pretty much the uptrend, and we broke down and we're back testing it. Also, there's that 40-week moving average, which is the same as a 200-day moving average. It does a very good job at defining bull and bear markets, although it is traded through. It usually gets traded through by, a few weeks at a time. Just keep that in mind. But right now, we're really struggling with it. We might be a hair above it at this point, but not by a whole lot. And again, it's not uncommon to see us whip through for a few weeks and then go back down. But either way, I'm putting more stock right now into these trend lines as well as the resistance levels that I'll get to here in a second. So there's the NASDAQ composite. Let's look at the NDX. Same story. Here's that primary uptrend line. I could probably draw this similar line off the 2011 lows here, and you can see as I draw that, coming here, catching all these reactions back here, reactions up there, have to slice through. That was a 1 day, and we actually closed back above, it's a green stick, so we closed above that level. And so we're pretty much, for the most part, back testing or maybe just above it by a hair right now. Let's see how we close the day here. Again, the divergent highs were the tip-off that this would break down and that there's probably more downside to come. All right, I could go over every index. They're all going to be the same. The S&P 500, so I won't do that now to keep this video relatively brief. Let's look at the daily chart. Okay, this is the NDX. Now, the NDX has been leading index throughout the entire bull market run off the 2009 lows. And so far, as I pointed out, it's lagged the S&P 500 with all the beat-down energy and material stocks and things like that, has actually rallied, has led the advance off this recent low back in February. I harped on, and I continue to really harp on this area here. This was that consolidation. There was a sideways trading range in late 2015. I I have a box there at the bottom of the gap. This gap, that was the last trading day of the year right here. This was December 31st, and then the markets opened on the January 4th, excuse me, and gap down. And we pushed back up. We had a little back test at the bottom of that range right there. This box denotes the bottom of the range. And I've talked about this for a long time. In fact, I said when we got here, I wouldn't be surprised. I said I wouldn't keep adding, but I wouldn't be surprised to see us go back up there and back test that range. And I mentioned this in the last video. You can reference that. I believe I was talking about the NASDAQ composite. This is my line in the sand here. There's a lot of momentum. I really don't want to see us get in and fill this gap, but that's a possibility. And I'm talking when I say I don't want to see that, just from my current positioning, my current bias. I'll take it as it comes if we take that out. But if we do enter that gap, and I'm talking a daily close, we might pop up through there intraday, maybe tomorrow, maybe in the next week. This is the red line, the line in the sand that I talked about. There's a possibility that we backfill that gap, especially if we get into the gap. I'm talking about this large gap here. But we have absolutely no business being above that level, and or we're most likely going to see new highs if that gets taken out. So that's the NDX. You can see that gap just as well on the composite, NASDAQ composite right there. And you can see where we're at right now. Technically the bottom of the gap was there. That's where we gapped down this candlestick right here. But I look at the day after. I look at the reaction at the closest point to the bottom of the gap. So we had that reaction the next day. We pushed back to back test the bottom of this range. So this is really the levels that I'm drawing here. And you can see the NASDAQ composite's lagging a little bit behind the Qs. And there's where the prices gap down to that day. So there's a lot of work to be done. In other words, this is the resistance level that I've harped on for months as what I call uber, mega resistance right here. This whole, especially the bottom of that trading zone. Let's take a look at it on a 60-minute chart or a 2-hour period chart. Okay, we can see it here. Same lines I have drawn. I think I have a shaded box drawn. Hold on 1 minute. Yeah, I do on the NDX, again, defining the gap there. So that's where we're at. We're right there challenging the base, roughly the base of that range right here. There were a few reactions down there. So this was a line as well, and I didn't want to see that line get crossed. As I mentioned, this is the point where the way I view it is, from every tick above this line here, which was the bottom of that range, although that's where the gap occurred right here, and then we had that push back up. So I should probably draw both of these, orange lines. This is where we should reverse. If we get up and fill that gap, as I mentioned, that's the danger zone. Anything above there, if the bulls can break that out, especially close above that level and get up in here, then again, I think that new highs is almost like a magnet. We'll probably make those. That doesn't mean, I want to be clear, I personally, the longer term charts will not have changed at this point if we take that out. So what's going to happen? I won't flip a switch from a bearish outlook to a bullish outlook. This is to me no man's land. What I'll do is I'll either step back from trading, sit and watch what happens, because I still think until the longer term charts confirm a word an uptrend, the market just may need to fake out as many shorts and bears that are in the market and suck in enough bulls before it reverses. Sometimes that happens. In other words, I don't see an all clear above this line is what I'm trying to say. And I'll have to determine if and when we get to the previous highs, if it looks like a buy signal if we take that out. So again, I would probably be on the sidelines. And also, what you guys know I tend to do best is find the best looking setups, long or short, in different sectors. Trading the market has been very almost futile lately. Obviously, if you were long and just sat long down here and stayed long, then it's been almost a straight ride up. I was bullish and long throughout the bulk of this, and then started unwinding, getting short about this level, and scaled in and then stopped, and we'll wait to see some type of reversal at this point. But that's it, guys. We're at massive, what I consider very significant resistance, and that's the NDX. Now let's just look at a few more. Here's the IWM. There's its comparable gap. We're on the 2-hour time frame here. So you can see that trading range wasn't as well defined in the small caps. But we had that, which I'll circle here, that big important gap down from December 31st to January 4th, the first trading day of the year. And you can see that we gap down to that level right here. See this line? We had that reaction low before there back on February 14th, it looks like. I'm sorry, December 14th. And so we gapped down, took out right below the bottom of that trading range, and back tested it. And look where we are today. Literally on a scale 1 to 10, I would give this a 10 for resistance. So that's why, despite cries that the Fed will keep this market going forever, I don't take that stuff into consideration. Honestly, I don't. And I've stated this before. I think the Fed definitely has the power to manipulate the market in very short term, especially coming out and jawboning, saying they're going to do this or that. I put absolutely zero stock into what they say they're going to do. They're going to be reactive. If the market starts dropping, they're going to come in and say that they're going to keep printing money. If the market gets a little frothy, as it did back here, and then when it was making new highs and the valuations were getting out of whack, they saw a little bubble forming. They pricked the bubble by saying, by doing their rate hike and first talking it up before there and then giving the rate hike, and that's where the market cried foul. It's just a game. So anyways, Again, short term, I'm not dismissing the power the Fed has, but ultimately, I do not believe they can alter supply and demand dynamics in the market. They just can't do that, or else you're in a new unprecedented era where the market will never go down again. Think about that. We've always had corrections. The market is going to follow the business cycle. Period. When we have expansions, we have bull markets. When we have contractions or recessions, we have bear markets. It's as simple as that. And the market, remember, looks out 6 to 9 months ahead. So keep that in mind as well. The economy is doing okay right now, but you won't know it's in a recession or hear about it, or especially hear it confirmed by the government that we're in a recession until long after the fact that it's already taken hold. All right, that's that. So there it is, guys. There's a market at resistance. What else haven't I covered lately? The 60-minute charts here. I only have, as far as broad market shorts, the Qs and the IWM are the only official shorts and the only ones I have personally. And I mentioned the IWM continues. The small caps. Yes, they made another new high. Yes, it's another divergent high. That doesn't mean all of a sudden divergences don't work anymore. As I often state, nothing is 100%, but divergences coupled with bearish patterns are as good as it gets to the holy grail in trading. I love bullish falling wedges and bearish rising wedges when they are confirmed with divergences and other things, and that's what we had here. Now this one didn't play out the way I thought we'd have more downside after this yellow trend line broke. What happens? We've slogged around sideways. The Fed has fought this breakdown, but the markets really again, they're challenging that resistance level. They still have divergence as they push to this marginal new high. And so whatever happens here, they're in this little trading range now, if you will, for the last few weeks right here. At least, well, they're all the major indices look the same. This is the small caps here, and that's the key right here. If we punch up through there, especially if we can backfill the gap. Here's that December 31st gap. We take that out. These divergences will be negated or burned through. They're not going to be in play anymore, and that's going to be a very bullish technical event. I'm sure most of the world, anybody that uses technical analysis, even those that don't, are aware of that big gap and really how we had that trading range back there in late 2015. And so this is where we need to reverse here very soon, folks. And until we do, really nothing overall, especially in the longer term picture, has changed. And downside targets, I still have a stop on the small caps. I think it's, 1030? I'm trying to remember the number. Yeah, I think it's 1130 if I'm not mistaken on the Russell. Okay, guys, I'm going to wrap up here. So just to reiterate, I will, expect to fully engage the markets next week. I'm sorry, engage the charts, not necessarily trading-wise. If something significant develops, let's say a sharp reversal off these levels, or we break up and backfill that gap and move through, then yes, I will be aggressively scaling out, maybe just a full close everything out on a close or a big move above that level. I'll communicate my thoughts on that on the index shorts. But remember, the index shorts are just a small part of the portfolio, and I always focus on the, trade various things. Be diversified in your trading account just as you would be in your 401k. In other words, don't have all your money in small cap stocks or even in equities as general. Trade commodities, trade gold, oil, trade long and short if you can. That's typically how hedge funds work. That's how hedge funds were developed. We used to, back in the day, we had mutual funds, and all they did is invest in stocks, and they were always long. Then we had the proliferation of hedge funds, and they're all different. They don't all have the same business model, but the fact is most of them are able to invest in whatever they want, and they also diversify, and many do long, short. And so that way, if you're wrong on your shorts, then you're right on some of your longs. And if you're wrong on commodities, your market calls are okay, or your individual stocks. So, all right, guys, this has been Randy Finney with Right Side of the Chart. And as I said, trade ideas, hopefully I'll have those updated. If not, it probably won't happen by this weekend because I'll be out of town. But I will, first thing next week, clean up the trade ideas and then turn my focus back to the charts. And if the markets are still ambiguous, as far as the near-term direction and tough to trade as they have been, I will focus back on putting up the best-looking individual stock and ETF, sector ETF setups, both on the long and short side. Okay, and this has been Randy Finney with Right Side of the Chart. Hope you enjoyed.